Hi, I'm Corey, friends with Chad. I just watched their video on partnership and distribution of properties, and I'm going to explain it in my own words. So, my understanding of the section is that one of the partners contributes some property, and then if within 7 years they want to uh, distribute that property to another partner, then there's basically like certain rules on how they would tax it or like how they would deal with it exactly. When the property is distributed to the non-contributing partner, the contributing partner is the one that recognizes that as a sale. Okay, so my understanding of like built-in loss would be a partner spends like $1,000 on some property. And then when they enter that property into the partnership, it's worth $500. So, and then a few years down the line, it's still worth $500, and they decide to distribute it to another partner in the partnership, then they would have to recognize that as a built-in loss of $500. And on the other end, for built-in gain, say that a partner spends $1,000 on some property. When they enter that property into the partnership, it's worth $5,000, and then in like few years, they decide to uh, distribute that property to another partner in the partnership, and it's worth $5,000 still. Then they would have to recognize that as a built-in gain of $4,000 and be taxed on that. All right, so I like wrote down an example to like explain, I guess, like my understanding of it. So it would be partner A contributes a property, and the basis for the property, or like what they like spent for the property, let's say like in a building, was $10,000, and at the time they entered it into the partnership, the fair market value was $25,000. And then partner B just enters $25,000 cash, so that would just be like so that's like into the partnership, so that's fair market value and basis would be the same. And then 3 years later, partner A distributes, or the partnership decides to distribute the building that property or building that partner A contributed. They decide to distribute that to partner B, and at the time of just when they're distributing it to property or to partner B, it's worth $25,000 fair market value. So then partner A would recognize it as a gain of $15,000, and they would be that $15,000 would then be taxed. So, kind of in conclusion of like my understanding, I guess, basically what this section would mean would just be, or it tells the partners that they need to be careful when entering uh, entering properties into a partnership, and keep in mind the basis or what they spent on it and the fair market value, and also to and be mindful of when distributing those properties too in the partnership, because you could end up having to spend or having to pay more in taxes, I think, and then or suffer substantial losses. Um, yeah, and I would say that's my understanding of it, I guess. But as far as the grade goes, like I thought they did a really good job explaining, and I thought they made it pretty easily understandable for someone like me. I don't know anything about really taxes or partnerships or anything like that, so I'd probably give them I definitely would give them an A. I thought it was a really good video, and I learned decent amount. So yeah, that's all for me, I guess.